Welcome to KNN. KNN is brought to you by Bob Knakal, Chairman of New York Investment Sales at JLL.
Hi, I'm John Hageman, Managing Director at JLL. Welcome to KNN. Today I'm here with Bob Knakal, Chairman of New York Investment Sales. And today we're going to talk about the year-end 2021 Manhattan investment sales metrics. So Bob, the year-end numbers are in, the fourth quarter ended in a bang. Tell us what we saw. Let's talk about one of our favorite metrics, which is total dollar volume.
Hags, thank goodness for the fourth quarter, I'll tell you that, because it was looking pretty bleak there through the first three quarters of the year. We were remarkably on pace to be below 10 billion in sales based on annualizing the first three quarters, which would have been less than the 11.1 billion in 2020. But the fourth quarter rallied and pulled us out of it. We had $6.8 billion of sales volume in Manhattan for transactions above $10 million. And that brought us to 14 billion for the year. So the dollar volume metric was up 26% from where we were in 2020, which was very, very positive and very much needed by our industry.
Bob, that's very encouraging. Why don't you tell us how that stacks up historically to the metrics we've seen in the past?
Well, if you look at the market peak, Hags, it was in 2015 when we had 57.5 billion. So the 14 billion of sales that we had in 2021 was significantly below where we were at the peak of the market. And if you look back on the average over the past 7 or 8 years or so, we're probably in the 25 to $30 billion range. So still a long way to go, but things are shifting. They're getting more positive. People are more optimistic. We had an unprecedented 66-month correction in investment sales in New York, which began in October of 2015. That's 5.5 years that we were in this kind of very, very challenging market. It started out, the first 52 of those months were a mostly volume correction. Then COVID came along, turned it into a value correction. That was particularly acute in Manhattan. But we absolutely will take the 14 billion, even though it's not a banner year relative to years of the past, but it's a very, very tangible sign that the market is shifting, it's getting better, and we expect great things for 2022.
So Bob, let's talk about our second favorite metric, number of buildings sold. How did that stack up in 21 versus 20, and then maybe give us the historical perspective to that too.
Right, well, Hags, I would say that the number of properties sold is my number one favorite metric.
Yes.
Only because I think it's more indicative of the real activity
Very
in the
true.
market. Because, again, large transactions can skew the dollar volume very significantly. But with regard to number of properties sold, fourth quarter again, a great quarter, 65 sales, over $10 million. That was the highest quarterly total going back to the fourth quarter of 2018. And to go back to dollar volume for a sec, the 6.8 billion we had in the fourth quarter was the highest quarterly total going back to the fourth quarter of 2019. So robust numbers, both dollar volume and number of properties sold, but the 65 sales created a total of 167 deals in Manhattan, over 10 million last year. That was a 61% increase over the 104 that we had in 2020. So an even more robust increase in the metric, and that again, very, very positive for the market, leads to optimism, and is a reason why I think there's a whole different attitude and feeling in the industry these days.
Bob, you mentioned the 66-month correction that we're in. What does that mean as we look to 2022 in the market in general?
Well, I think there are a lot of implications for that, Hags. The 66-month correction was the longest that we've ever seen, going back to at least 1984. Even during the S&L crisis in the early 90s, that correction only lasted about 48 months. So it was the longest we've seen. Typically, these markets are always cyclical, and usually the more something, if you think of the market as a rubber band and you're stretching it down so far, when it bounces back, it's got to bounce back really quickly, and that might be part of what we're seeing today in the market with the sales numbers that we're seeing, the robust activity in the residential market is coming back really, really well after we saw a horrific vacancy and diminutions in rents that we had never seen before. That market seems to be coming back stronger than ever. So I think the implications for the market moving forward are that because we were in this down market for so long, that we should be poised for the market to really take off and run over the next several years. And each product type is performing differently. We're seeing good strength, remarkable strength actually in the multifamily sector, great traction in land sales, retail and office still trying to find their footing, but everything is set up to really be very, very positive moving forward as we get into 2022 and beyond.
Bob, you mentioned the forecast. We're here in just the beginning of 2022. What's your forecast for what we expect to see this year and on the metrics that we talked about?
Well, if you look at historically how these things have gone, you would expect that that the number of properties sold will continue to increase at a growing rate, and that's because it's not unusual to see the 61% increase in number of properties sold and a 26% increase in dollar volume. The number of properties sold historically has been a lead indicator in the two volume metrics, that number will pick up before the dollar volume picks up. So we expect that to continue and expect to see a higher rate of increase as we get through 2022. And I think based on the number of valuations that we're doing for potential sellers today, the activity that we have on the listings that are on the market, the contract signing activity we have, I feel confident that 2022 is going to be a great year from a number of properties sold perspective. With respect to dollar volume, one of the interesting things was that there were not a significant number of office buildings sold, but yet the dollar volume was over $6 billion in the office sector. That office sector is always the lead of the dollar volume product types, and we expect that to continue based on the properties that we know are on the market today. We're going to see some very large office transactions that are happening. But I think that we're going to see a big increase in dollar volume as well. And if you look at how the market volatility goes through up cycles and down cycles, it tends to revert to the mean, and we have a long way to go to get to the mean. But I think that if we don't have any externalities that could impact the market, we should be on a course for several years of very positive increases in both the number of properties sold and the dollar volume.
Bob, you mentioned externalities. Which ones are you talking about that we think might affect them?
Well, a number of things, Hags. As you know, tax policy is profoundly impactful. It looks like the inertia that Washington is going through now could actually serve us well, and that it doesn't look as likely that we're going to have big capital gains tax increases or modifications to 1031s. But there are a number of other things that are going to come into play, like interest rates, what's going to happen there, what's going to happen with local policy relative to the 421A tax abatement program, rent regulation, a host of other things that can impact the market. But as provided we don't have something that is catastrophic relative to these externalities, we should be on pace for a really great ride for the next several years.